Hi there, everybody, and thanks for joining us for our latest episode of Brokercast. This time we'll be talking specifically about asset finance deals with clients in the transport sector. Joining me is Jonathan Dent, one of our senior asset finance underwriters, who'll be giving us an underwriter's perspective on what they're looking for when a transport sector deal lands on their desk, and any tips he has for brokers if they want to help get things through quickly. Thanks for joining me, JD.
Thanks, Craig. Happy to be here. I just want to sort of almost give a positioning statement first before we discuss the specifics. Just the basics of underwriting and how we look at a deal to start off with. It's on two levels, basically. The first thing we look for is what we call red flags, so indications that something's quite not right with the deal. And there'll be a couple of examples I'll come to later on that. The second level is the actual credit assessment, where you look at the risks and the credit covenant, etc. Once we're confident, we do that part once we're confident that the client is what they say they are and do what they say they do, etc., etc. So one of the more important things looking at that is the knowledge that the broker has about the client and where they've got the deal from. So that, to me, that's critical. So moving on.
Well, generally our brokers are good at that, but that, as you said, it always helps. One thing that can't be ignored is the current cost of living sort of crisis. We've got soaring inflation, rising fuel costs, interest rates going up, etc., etc., etc. From your perspective, how have we seen that affect customers? And in particular, is there anything brokers can keep in mind to do when making an application on behalf of the client?
Yeah, there's a few obvious things. It's tempered in the haulage sector. It's tempered a little bit with the demand for hauliers at the moment. You know, you hear of driver shortages and long delays in sourcing new vehicles, etc., etc. Whilst because of that, they can generally pass on rises in fuel. They're not immune to interest rate rises. We've seen a few of those recently. We're going to see a few more. Also, the pundits reckon, where their working capital is provided by a variable rate facility, such as an ID line or a traditional overdraft, then where their interest cover is tight already, some commentary from the broker about what they're doing. You know, are they only drawing down a certain percentage of their trade debtors in their ID line and they've got more to go at? Perhaps they're looking at remortgaging, etc., etc. But just some detail about how they're dealing with it will mitigate that. Like I say, it used to be that interest cover, because interest has been so low for so long, wasn't really a metric that was that important, but it's back on the table now with a vengeance. So, second point is, as part of the proposal, go into a bit of detail about who they work for. For instance, food haulage would be seen very positively. Whereas if they're moving new cars around, for instance, you know, there's not many of those happening at the moment. And also, if we can have any clarity about who they're working for, see if there's any debtor dependency, so they're mostly working for one client, that might be a negative or that might be a positive. If they're working exclusively for the MOD, for instance, you'd take it very much as a positive, but just paint a picture for us. I suppose the final point in answer to that question is we've had a massive flood of liquidity in the market with CBILS, recovery loans, bounce back loans, etc., etc. They're all having to be repaid now. Sometimes I do see nice credit balances in a client's bank statements, but you see the trend is declining downwards. And at the same time, you can see that they've got C-bills that they're having to repay now that's still got significant funds on it that, if it was due on demand, they wouldn't be able to pay it. Thankfully, they're not, but, it's slowly going to leach their working capital away over time. So just be aware there's a danger that liquidity can dry up, and we're looking at long-term funding. So again, a little bit of clarity about that, and what government-backed debt the client's got will be of great help to people doing my job.
Thanks, JD. Another challenge the sector has faced is significant shortage of supply of vehicles. From your perspective, what kind of challenges does this throw up?
It's an odd situation. I don't think I've ever experienced it before in, sadly 30 years of doing this job.
Not that many.
I actually had a dealer the other day. I was querying the price of a truck, and he basically admitted it was £30,000 over what it should be, because you have to wait 2 years for a new one. And that's the price you can get for it. So there's a supply and demand. The problem is that where the credit covenant's strong, we're obviously there to lend and to support SMEs. So you could take a view. The difficulty is where the credit covenant isn't perhaps as strong, that perceived possible 30 grand overpayment at the front end is going to have an effect on our recovery rate given default all the way through the deal. And it might just push the decision into a decline at the front end. It is a very difficult one. At some stage it will unwind. Whether or not that's in a year, 2 years, 3 years time, nobody knows. We're an SME lender. We're there to help. We just have to take a view on a deal by deal basis. But one of the things the brokers can do to help us is give us the full spec of the vehicle, especially in transport. It's a daily occurrence. I just say, 2019 DAF. It's not very helpful.
Yeah, there's lots of models and makes and variations.
Axle configurations, rigid, tractor unit, what body it's got on it, tail lift, cab, etc., engine power,
Of course. Well, thank you for that, JD. That's helpful. Just sort of getting towards the end now. If you had, say, 3 key tips for brokers on how to make a killer application on behalf of a client in the transport sector, what would they be?
Well, I'm going to be controversial here, and so I've actually got 4. The first is you send it to Allica.
Okay, I like that.
Thought you would. 3 key ones for me. And this relates back to that mentioning of the red flags sort of spotting and at the start of the chat. Check the ultimate beneficial owner, what we call the UBO. If they are not a director, or they are not directors, if there's more than one of them, that is very rarely without some reason behind it, and quite often the reason isn't a good one. We've had it recently where the directors weren't, the shareholders weren't directors because they'd basically been disqualified, and one of them had done time for fraud.
And it was one of mine. Sorry, JD.
Yeah, it was. I thought I'd mention it. The other part of that is that if there's changes in directors, just ask yourself why. Does it look normal? Is there a where perhaps an aged director has stepped back for a son or daughter to step in? Yeah, fine. Where it's somebody completely different and perhaps not surname compliant with them, just put a bit of detail around it. It might be a son-in-law. You never know. But that is one of the red flags that we always look out for. Second point is the UK road haulage industry is one of, if not the most heavily regulated in the world, with a network of traffic commissioners and VOSA inspectors, etc., etc. There is a plethora of detail around the granting and constant reviewing of operating licenses. On the VOSA site, there's actually two search engines. There's one that just tells you if somebody's got an operating license and it's valid. There's another one that gives you the history of that license, and you can see various things on there. You can see whether they've had public inquiries, whether they've actually had their license curtailed or revoked, who the principals are of that business over time. And specifically, a good tip for brokers is where you're talking to a non-incorporated entity, so a partnership or a sole trader, and they're in this sector, just have a look at their O license and it will tell you exactly what the composition of that business is. Because quite often people don't think, and where perhaps they're sleeping partners, they perhaps don't disclose them. So you're going to save yourself a request for more information when we check and find out there's actually 3 partners, not 2. And can you give us the details of the third partner? One of the things it will also tell you is basically where the business operates from. And it's a very basic thing, but if the directors live 100 miles away from the operating centre, ask yourself why, or ask the client why, because it's unlikely they're doing a 200-mile round trip every day to go and manage their vehicle fleet. Finally, a lot of the smaller hauliers pay themselves via dividends. And this comes back to the cost of living question. They'll typically pay themselves a nominal wage, 10, 12K in their accounts, and then they'll take the rest via dividends, which is fine. It's a tax efficient way of paying yourself, but it's overstating the business's profits to a degree. So with regard to cost of living, just ask the question, how discretionary are those dividends? It might be they need them to live on. It might be that they're almost semi-retired, living in a mortgage-free house, no debt, and they just like 6 holidays a year so they can tighten their belts. But just tell us the story so we can get to your deal first time round and continue supporting you.
That's brilliant. Thanks, JD. So in summary there, the more information, the better. I'd like to say thank you for your time today. Hopefully that'll help some of our brokers out there. Cheers, JD. Take care, mate.
Hope so. Cheers. Cheers, Craig.